we can't look like we're dying. Wait, I don't remember the introduction. Hold on. Paddle balls has sign, no?
Explain ROAS. Okay, explain return on ad spend.
Stressing me out. Stress on camera now. क्या कुछ गलत बोला क्या? तो फिर
चल move.
Please analyst. Arre, I'm waiting. Again. Welcome to entrepreneurs.in. Today we have someone who went from being a content creator and still is a content creator to VC, a very unconventional path but has a lot of insights to give. Welcome Jaitra. We are so excited to have you here.
Hey guys, thank you so much for having me, and I'm really excited to see what you guys are doing here. I mean, it's fantastic I came here and I was like, these guys are doing something insane, and thank you for having me.
So, how's your day been? What was the journey like here?
It was an interesting day. I think it's a good Saturday, something I look forward to. Definitely, I love conversation, and especially when it's with friends, I love it even more.
So, we know that this is your rest day and you prefer sleeping in. Thank you so much for taking the time to coming here and being here today. We really appreciate it.
Likewise, thank you for having me.
So, let's get started. Would you want to walk us through how you broke into VC, where you studied, and what is your pathway?
Sure. So, I'm from Bombay. I've grown up here. Studied in a very very local Mumbai peak local Mumbai college, Jai Hind. I did my BMS there. But I caught a bug in my second year with entrepreneurship and startups, and it really caught my eye, and it was just something that made me want to go deeper into it. And especially when I was in college, it was 2020, 2021, peak funding phase. Literally free money floating in the ecosystem. There was so much hype around it that that one naturally gets attracted towards exploring opportunities in it. My real exposure came when I started working at Groww when I was in college, and that was like for a student who comes from a commerce background in Mumbai, which is not known for its tech ecosystem, to then go and work in a Bangalore-based tech startup was like worlds, like it was like paradigm shifting for me mentally. When I was in college and my final year, I was figuring out what to do next. I also tried to start something of my own in my final year of college. I made money out of it, but I couldn't scale it because I think my co-founders and we all had the same skill set. I didn't have the ability to create a tech startup. I didn't have the skill sets to, scale things by leveraging technology at that point of time, and I didn't know how startups really worked on a fundamental level. And for that, I felt like I need to just get a sense of the ecosystem better, try to understand how founders work, what actually creates the DNA for a good founder. And VC seemed like a very logical option to get a bird's eye view, that I can observe 30 different founders, 50 different founders, and then draw patterns out of what are these guys exactly doing that is making them a successful founder. That was my approach when I started, wanting to crack VC. I opted out of college placements because none of those roles appealed to me personally. I chose for an internship instead with a VC fund in Mumbai. It's a pre-seed fund called 100x VC. I learned the early investing chops there for like 6 to 7 months. Just literally the basics of sourcing, evaluating, just getting a sense of how founders pitch, how founders operate, what is their mentality. I think those conversations really helped me. I've always been someone who's been interested in stories more than anything, and I look at every conversation with the founder as a story. Like, it's the most interesting part of the role. And I really got hooked onto it. At any given point of time, analyst roles in India are less than 100. Open roles would be less than 10. And the pool of people applying for these roles are IIT Bombay CS graduates, are top B school graduates trying to all compete for the same role. And you can understand how competitive of a pool it is and how lucrative it is for someone to be in that position. And that's when I thought content creation would be a good leverage. That if you can build your own distribution, if you can show that you can scale something 0 to 1, it shows that you've got some ability to execute, to think rationally, to think logically, to think analytically, and then double down on it. So I spent a brief amount of time doing content creation. It scaled very fast in a very small period of time. But as I was building that sort of content, I also came across opportunities here and there, and that's when I saw a LinkedIn post about the fund I work at. It's called 2AM Ventures. It's a US-based fund that has an India-focused thesis. We're a pre-seed seed stage fund investing between 150k to 350k USD. And I saw the opening and I was like, this is interesting. Let me try my luck. And these guys were hiring on Reddit. Like, it was the most unconventional hiring process in the first place. So
how big is the Indian team?
It's just two people. So
two
two GPs and two people. And
okay.
So myself and another junior analyst.
Okay.
But I was their first hire in India. It was a company fit for me as well because the way they were hiring and the way my profile and my journey was, it made sense, right? They were looking for something unconventional. I could offer something unconventional. They were hiring for an apprentice. They wanted to groom someone to, be in the team for the long run because the first hire, all of that. And when I saw the pool of applicants, I was like, there's no way I'm getting through because these are all ex-founders, second-time founders trying to get into VC. These are IIT grads, BITS grads, and these guys are golden geese in the market. When they come out to get a job in VC. I waited for 2 weeks. I didn't hear back. I was like, this is not happening. And then 2 weeks later, I get a message from Harshal, who's my boss now, and he's like, you're the front runner for this role. Multiple reasons. I had worked with his family before 100x, and 100x, the GP there happens to be Harshal's family. At the same time, he was impressed with the content thing that I was doing because he was looking for someone who can build out the fund's on-ground distribution in India. And I had shown some sort of proof of work that I can do that. I had a few rounds of interviews. I was also interviewing at other places at that point of time, but this just made sense. It felt right. It was a role that I felt was super high in ownership. It was an opportunity to be at the ground floor of a fund that has a very unique thesis. And at that point of time, to be very honest with you, I had 1 year of just clueless searching. And it's not an easy time. When you're out of college, you're 22, you're seeing, 21, 22, you're seeing other people already at jobs, doing something or the other. It feels like it happened very easily, but it was a lot of doubt, a lot of anxiousness on what is going to happen. And then this role happened for me at that point of time. And I'm super glad because it's a very high ownership role. And I got the opportunity to actually get a first-hand view of how to build out a fund in India.
How you were at Groww, you're in the growth / content creation team. You're basically focused on growth, which is user acquisition.
Yeah.
Right? Why transition into VC or why not transition into some other role in that specific company?
So it's quite interesting. I actually had a PPO from Groww. I was set to move to Bangalore, join them full-time in their team. But simultaneously, when I was at Groww, I was building a financial literacy startup out of college. And I saw promise there. I was making money. I had few senior folks from the financial ecosystem in India saying that, dude, if you build this out, we'll back you. And I was like, this opportunity is never going to come back again. At Groww, I am one person in a 700-member team. People who have created the impact in that company have already done that. In Groww specifically, I will be able to give my inputs in a specific function, in a specific business function. And I like being a generalist, and being a specialist at that point of time was something that wasn't the most appealing to me. And I had an opportunity that felt like makes sense to dive in and see what happens out, because nobody around me had ever experienced something like that. And I felt like it's worth giving it a shot. My failure as a founder made me want to build more chops in understanding the startup ecosystem. That's why I chose VC. It wasn't that. The transition was more to do with my failure as a founder.
So, and at FinSchool, were you creating like similar content to what you were creating for Groww?
No, FinSchool was a financial literacy live cohorting startup, which means we were taking people from the age group of 16 all the way till 64 in a single cohort, teaching them how to invest in mutual funds. It was a tie-up with Franklin Templeton. They were kind enough to see some promise. They wanted to build a distribution channel to increase their flow of their acquisition of mutual funds as well, because they run their own mutual fund product in India. So it was an obvious synergy and an obvious collaboration that made sense to both of us, and that's what we did there. So it was, I wasn't making the content, or I wasn't packaging the content, I was the distribution channel for it.
Alright, so just circling back to what you mentioned before, what is 2AM's thesis? Is it just India in general? Are they bullish on India, or is it something specific that you look into in the Indian market?
Yes. So 2AM, it's a US domiciled fund. Both my GPs, as general partners who raise the fund, who run the fund, are based out of the US. Both are American citizens, born and raised there, but with an India focus, which means they only deploy capital in Indian startups, building for India or from India to the world. Very simple reason to do it. The US markets are fairly saturated. There are insanely large VC funds with crazy track records built over decades that get access to deals before anyone else does. And then after that, it becomes a valuation war where there is not much outcome to get after a certain point of time. Rather, there is a trend where these funds are looking to expose themselves and get exposure to the emerging markets like India, Indonesia, MENA, and all of these other geographies. So it made sense because Herschel, who's a GP at the fund, GP and founder, his family has been investing in India and the US in startups for the last decade and a half. Early check writers in Oyo, CoinDCX, Box8. Herschel was the first check in Zepto. And these funds in the US and these large check writers in the US are looking for exposure, but India is a tough market to crack if you are a white guy sitting in Silicon Valley. Pre-seed seed stage fund, which means we only invest in rounds smaller than 2 to 3 million in general by thesis. We do larger rounds if we feel that this is an exception. But that's generally our thesis. We're sector agnostic, which means we look at everything. We're not hell-bent on a sector, but we're super bullish on India's consumption. Just to quickly summarize and double-click on what I mentioned with the US to India corridor. What also happens is that once Indian founders raise their first round, their pre-seed or seed round, larger funds take a lot of time in India to move forward because they have so much optionality right now. And they are not under pressure to deploy capital very fast. Whereas US check writers will cut 2 million, 3 million checks in literally one call. Indian funds will ask you for data for 6 months, like large Indian funds. I won't name them, but they'll take 6 months to do that diligence. And VC investing is driven by FOMO. So unless and until you don't create pressure for a fund that you will miss out on this round, you can't push them to cut a check fast. So if you have an American fund and an American investor saying, I'm going to cut you a check in a call or 2 calls, you have instantly made a tier 1 VC in India excited about your deal. And that's the leverage we can provide as a fund.
Going back to why you switched into VC, right? You were talking about how you want to stay close to the ecosystem and recognize patterns of behaviors between these founders. Do you think after you've done so, is that a good strategy for an aspiring founder like someone like Namrata? Today she knows that she wants to be a founder, but she doesn't know what she wants to build, when she wants to go at it. So today she's thinking about going to VC just to stay close to the ecosystem. So is that something that you would support? What are your thoughts on that?
Traditionally, VCs have been able to raise their first round easily. No, I wouldn't say easily, but it's far easier than regular founders to raise a round because you know exactly what the investor wants to hear. You have more market intel than most people do. But there's a flip side to it as well. You can, while VCs will have a bird's eye view of what's happening, they've not gotten their hands dirty to understand what's actually happening. So somebody who's worked in a founder's office for 3 years or 4 years in something like a Swiggy and back in 2016 is way more valuable to be invested in than I am today. Or someone who spent 4 months at 4 years at Excel. It's a very, very different journey. So while I'd say yes, you get way more context as a VC to spot patterns, to get market intel, you have the networks to leverage to get that first associate partner level call through your connects with a VC fund. I don't think it's net, it doesn't make a difference to me. Like net, the field is pretty evened out for anybody who has actually put in the effort to build some sort of credibility before they're starting up.
what is your go-to for someone who's 20, 21 today, coming out of college, wants to build something, doesn't know in what space, but wants to stay close to the ecosystem? Should he or she go join a specific startup, or should they go to a VC fund?
If you come from a tier 1 college in India, you have the opportunity to work with a A-grade founder in India. So go and do that. Learn it. If you want to start up. If you don't want to start up, you can always join a VC fund. Not a lot of people reverse track this journey. I wanted to be a founder back in the day. That's why I chose to be a VC. But today my perspective is very different on what I want to do ahead. So if you're coming from a tier 1 college, highly recommend you to work under a startup and these founders are all alumni. Like if you're coming out of IIT Bombay, you can definitely find one IIT Bombay founder who's raised significant amount of capital from one of the largest VCs in India and is open to hire you. These guys are very, very, their club is very, very exclusive and they're very supportive internally. If you come from a tier 2 fund and you have no my bap, like technically, you have to figure out, you have to literally do whatever it takes. Then you can't analyze it so much and you can't backtrack the journey that much. Then whatever comes in your hand, ride with it.
Now when it comes to a founder, right, they don't know how to go about fundraising. So usually they wait for too long or they just don't know how to approach it. When it comes to VC, should a founder start building a relationship before they try to raise money, be like on everyone's radar, or is this something that you should just approach a VC right before you're funding? Like how do you go about this?
So this changes from stage to stage. If you're a Series A, if you're trying to raise a Series A or a Series B round, then it's always good to keep VCs warm because they know that these companies have a certain level of credibility. And in general, the volume of companies that reach that stage of investing are smaller. So they have the appetite to look at everyone and make a fair analysis or build a warm relationship with you. In pre-seed seed, you have such large volumes of companies coming by that if you put a bad taste in my mouth once, I will need 7 mouthwashes to get over it. So never pitch to a VC at pre-seed prematurely. You will probably never hear again from there if you do that. You'll not get a response from them. And it's just a law of, it's just the nature of the business, right? If I'm talking to 7 founders in a day, how am I possibly supposed to maintain a relationship with everybody if some of them are just a 0 to 100 sort of a journey for me mentally to build conviction. A 99 to a 100 I understand, a 90 to 100 I understand. I can mentally be prepared to say that, look, there are certain gaps in this founder's approach and journey right now, but I can track him to see that this guy can probably turn it around, or this lady can probably turn it around. For me, when I look at it, I have to be very cognizant that I'm not wasting time with founders that are absolutely clueless about what they're doing, because I'll lose out. At the end of the day, as a VC fund, I have a fiduciary duty to my LPs. It's good to be supportive to the ecosystem, but at the end of the day, you have the responsibility of handling someone else's money, which you should take seriously.
And how do you go about sourcing these startups? You like you said, I'm sure a lot of people approach you.
Yeah.
It's a simple LinkedIn search and you find the first VC and you just shoot out their pitch deck. So how do you go and source these really unique startups out?
So there are, I think at an analyst associate level, there are 3 pillars to sourcing. First is LinkedIn, which is your outbound, where you have to be very technical with your keywords, and everyone has their ways to go about it. It's something I enjoy the most. It's something that has been the most effective for me personally. A lot of people will disagree with me. A lot of people, for them, it's otherwise. They feel that LinkedIn does not help a lot. But for me, LinkedIn has been immense. It's been 70% of the deals that I've taken to a partner call or have gotten funded. So LinkedIn is one. LinkedIn keyword search is one. For a lot of D2C funds and consumer funds, they actively look at ads. A lot of ads, a lot of early stage brands run ads. They list on e-commerce, so you'll do an e-commerce scan. And I saw a very interesting protein bar brand through e-commerce recently. So all of these channels, and then you do an outbound reach out to these founders. That's one pillar. Second is you build a network. If I have invested or if I am friends with 10 founders, those founders will be friends with 10 different founders, which just multiplies my network 10x. And if any of those founders are building, I need to have a relationship with these 10 founders in a way where anybody in their circle is building will send me their deck saying this guy's building, please have a call. And that's the best way to get a conversation with a VC as well, because cold reach outs, unless and until you have the numbers, don't make that big of a difference. Warm intros are always, there's always a safety net, there's always some sort of signaling behind it. And signaling is a completely different, it's a topic I can speak for one entire hour when it comes to VC. So I think networks plays a very important role. And that's the reason a lot of people also want to hire from an IIT Bombay and IIT Madras, because there are so many founders coming out of that ecosystem. There are so many alumni. It's such a big pool of founders that comes in and high quality. But you have to figure out your way to build a network. If you're it's a very social role. If you want to be a good analyst associate and you want to stick around in the ecosystem for more than 3 years, you have to learn to be a people's person. And if you're not that, this role is not meant for you. And third is your inbound and distribution you build for yourself. It could be content. It could be a community that you run. It could be a newsletter that you do. All of these create inbound sourcing for your fund. I think at a certain scale, with a certain level of quality, you can really crack inbound. It's a long journey. It's much slower, but it builds top of the mind like nothing else does. If tomorrow a founder, who's a SVP or VP at Flipkart is leaving to start up, he has to think of me as one of the top 5 funds when he's raising money. And that's the way I look at it.
Like one of the really cool things I feel that I did when I was at Battery was they used to make me look, so their thesis was around B2B SaaS. We were writing pre-seed to seed checks. And I was looking at the headcount growth of engineers of that company through LinkedIn Sales Navigator over the past 6 months versus a year. So that was a really cool insight that I had too.
No, 100%. I think what we also do is track a lot of exits at large. Like let's say Meesho had an exit, had a ESOP buyback event 5 months or 6 months ago, which means that a lot of senior executives are going to leave. They're going to cash out and leave. So you want to be at the right place at the right time to catch them and be like, okay, I think you're going to leave now, or you've already left. Let's talk about what you're going to build next. And then you can build that company with the founder and catch them on early.
Very cool, yeah.
So when you look at the whole funding environment, right? I think venture debt is something we don't speak about a lot in India. Venture capital is in everyone's mouth nowadays, right? What is your opinion on that? How is the ecosystem in India around venture debt right now?
So in India, you can raise venture debt if you have more than $1 million raised in your bank account, because venture debt is a very simple instrument, right? You are identifying businesses that have either enough runway or cash flow, give them financing so that you can get a return on whatever 13-14% and build out that loan book for yourself. Venture debt as an asset class helps a lot for businesses who require working capital and are more working capital intensive businesses, because equity is a very heavy price to pay. You don't want to use equity money in working capital because you're over diluting yourself and you're taking the risk of equity on yourself when there is a debt financing option available. And usually debt financing happens at a point where you've just raised a round, so you have enough runway, you have enough cash reserve in your company to pay back the loan over a period of time. So as an instrument, I think it's been super critical for a lot of companies, especially to avoid founders from over diluting themselves. And these companies are like less than 3 years old, 2 years old. No bank is going to entertain them. NBFCs will give them loans at a much larger, higher interest rate. It can screw up your unit economics, to be very frank. And you'll be in a position where you're stuck, especially for B2B businesses. Working capital is that business runs on how they can optimize for their return on capital invested. And if they have poor interest rates, it screws up their entire bottom line. So that's my take on venture debt.
So one key point you also spoke about is like over diluting at the start. Like how should a founder raising a pre-seed seed round think about the kind of equity that he wants to let go of?
So if you're a first-time founder raising money for the first time, don't think of dilution. Think of the larger picture, that 100% of 0 is 0 and 10% of $1 billion is 100 million. Think of it that way. Because everybody will make money and you need these people to make. If you're thinking that you want to make money for yourself, you can also make money for your investors. Everybody can make money. We were speaking about Zepto before this. Adit and KV together and their family owns about 20-25% of the company. But they own 20-25% of a $5 billion company. That is only growing. So in that sense, dilution doesn't matter at your early stages. You just need to move fast. If you have capital, you have the ability to move fast and you can think of much lesser problems. People who over-fixate on valuation and over-fixate on dilution usually end up moving too slow in the initial days when you have to just be super fast with executing. At the same time, there are VCs who try to optimize too much for valuation. I think you need to find if you have no option, then go with whatever you have. But you have options, try to go with the most, with the VC who's not very price sensitive. And I think net that makes a larger outcome for founders, especially with D2C, right? Because the outcomes are not $1 billion outcomes in most cases. The founder's over diluted. What is his incentive to run the business? Like if it's a 200 crore exit or a 300 crore exit, if the founder has 20% of the company, what has he put everything that he's got for 5 years for nothing? That effort to that risk to reward, effort to reward ratio doesn't make sense then. Consumer tech companies require dilution. You can't avoid that. But with consumer brands, you should be more VCs should be more sensitive about diluting the founder because it can dilute the motivation of the founder to build more.
So it's very industry specific, is what you're saying.
Yeah.
Very cool. And now coming to valuation, right? Now, in terms of larger companies at like say a later stage, we use your public comms, you have your DCF, you have your cash flows in place. But say something where you're creating a completely new industry, right? Quick commerce was a phenomena that took place for the first time in India.
Yeah.
And at that point in time, as per my understanding, wasn't there anywhere across. So how, like your GP wrote the first check to Zepto. That's what you said.
Yeah.
So how do you value a business like that? How do you underwrite the risk? What is the cost of capital? How do you go about it?
Again, depends from sector to sector. Depends from sector to sector, depends from stage to stage. At pre-seed, seed, mostly for pre-seed especially, all funds have ownership targets and they'll invest according to their ownership target. So if the founder is raising $1 million and a fund has a 20% ownership target, they'll price the company at a 5 million post. Very simple. Later stages, they'll look at the data, they'll use multiples on depending on where, from sector to sector, the multiples will change. Like in D2C, you will see like a general 3x over your net revenue that they account for. And in the exits that we've seen also, we've seen similar data, similar numbers. When it comes to SaaS, again, you see a 3 to 4x. Actually, SaaS multiples are way more because with SaaS, the input cost is so less that the output
Margins
makes
also
sense.
higher.
Yeah, margins are higher. So SaaS will give you better multiples. A B2B infra business or a B2B marketplace will have a 1x, 2x multiple or a 3x multiple. Indian valuations right now are all an output and all a result of the overflow of capital that was there in 2021, 2022, especially in growth stage companies, when everybody was getting a term sheet and everybody was fighting to get on the cap table, and whoever came with the larger valuation usually set the valuation terms.
So when we talk about valuation at a pre-seed or seed stage, what are the metrics that we can actually look at? See, because usually you must have received ideas or a very small product market fit or a very small scale business. So I think it takes a lot of intuition also to see, okay, this is going to be something big. What is that one or a few factors that change it for you? That, okay, this is a fundable startup versus this is not.
A second-time founder can command a much higher valuation than a first-time founder can. Pre-seed and seed investing is so subjective, it is so qualitative that there is no formula to it. There's no framework to go about it. But there are biases and heuristics on which people play and accordingly set valuations. One I told you is ownership targets. Second is if it's a first-time, second-time founder or it's a master operator. Like this guy has, built out Flipkart, first, second employer Flipkart. Like Sujit Kumar, he raised like a $10 million seed round or something when he started. Similarly, we did a round recently. We invested in a founder who was a senior vice president at Flipkart, was the CEO of ClearTrip. He can command a much larger valuation. He can raise an $8 million round because he's shown the credibility to build multiple things across the last decade. So instantly he gets a one-up on the valuation. That's also because his raise amount is much larger, he has to set the valuation has to be set accordingly that he's not over diluted. Third is the industry you're operating it. If it's a non-tech business, the multiple or the valuation will be slightly lower than a tech business, where ops are too heavy, where it's an asset-light business, a lot of working capital required. The valuation will be in a 1x or 2x proportion to your top line in most cases. But it varies again. There is no one straight answer to it.
Jaitra, what are some of the most common mistakes founders make while raising funds from a VC, and how can they be better at just fundraising?
So any founder who's first time founder trying to raise a pre-seed round I highly recommend go and watch Y Combinator Startup School, because there's literally a proper guide to how you should go about building a business first at that stage instead of going and raising VC dollars. You're not building a business to raise funding. That's not an achievement. It is a means to survive one day longer. Especially for first-time founders who are building, who's raising their first round or their, the very first check. For these guys, you have to go out in the market and show some proof of work. You have to show that you have spent 2 to 3 months just trying to get feedback from your user, trying to, you've just made multiple MVPs, gone out, gotten the data, and then you're moving fast. The best founders, in fact, we have one of our best performing companies in the fund raised money from us after they got passed on by every single VC in the country. They, on paper, they raised a fund from us. They raised their first round from us. But for the first 4 months, they didn't use a single rupee from the money they raised in that round. They put their own capital, built conviction, and only then started spending VC dollars, because that's when you're doing justice to that capital. Money and capital is a means, but it is not a solution to finding PMF. And you'll always run out of money faster than you'd generally think. When you're building out, first-time founder building out, going into the market, always listen to customer validation and not investor validation. Most people are trying to get a sense of what the VC is thinking, what the VC wants to invest in, but the VC is trying to see what the customer is looking at. What is their genuine pull from the market, instead of you using meta ads or using some sort of leverage to push your product to somebody, because in the long term that is not sustainable. We personally look for virality hooks, organic growth hacks, because that shows the scrappiness of a founder. And only when you have that conviction to say that this is what I have done, this is what the customer data is saying, and now I am confident to go and tell a VC that you invest in me, if you don't, you miss the bus. I don't lose out on anything. That's the kind of conviction that VCs want to see in the founder themselves. Secondly, when it comes to, going about paid ads as a concept, a lot of people use meta ads and Google ads to kick off their businesses. D2C businesses, I understand. You have to get a certain scale, you have to do it, and you have to get that sort of reach or discoverability. But there as well, you have to keep iterating on the product and keep trying to be as execution light as possible, because you can literally A/B test 2 different packagings and figure out which one is going to work, which is going to give me a better ROAS. And that's how you move faster, especially. And you can leverage e-commerce platforms as well to do that. And you see if e-commerce is working better or website is working better, and then within 3 to 6 months, the data will tell you where to go. You don't have to try to find the answers by preempting things and saying कि यही channel पे मेरा काम करेगा तो मैं इस पे ही बेचूंगा. That's not how it works. So always, I personally feel someone should use meta ads as a leverage only when they know that, okay, this is going to work, and I need to create a considerable distance from my second player so that I'm in a league that I am top of the mind for this certain product. So if it's, let's say it's, just giving a very crude example, if it's razors, I have to think of Gillette first, because that distance that is there between me and my next player has to be massive, and I'll only be able to leverage that if my product has PMF. If it does not have product market fit, I am building on literally doctored and adulterated scale. It's not genuine scale. In your early days, you have to find organic pull. If you don't, it's fine. We have a company called Numi, okay, in our portfolio. They're a women's fast fashion brand. They did pop-ups. They still do pop-ups, okay, across India. And in the first 1 year or 2 years they're a 2-year-old brand itself, but in the first 1 year of operation, they did pop-ups across the country, different cities, and said, we are not selling. We are just hearing the customer out. We don't care if this pop-up creates conversion. We don't care if this influencer marketing campaign is necessarily giving that ROAS as of now, because what this does is just gives us insights into understanding where to exactly double down on and figure out where we should ideally be experimenting once we find PMF. If I'm hearing 50 or 100 different people telling me the same thing and I've drawn a pattern, this is what they're looking for, and if my solution is is in line and is aligned with what sort of problem statement I'm chasing, then it makes sense to go and create that sizable distance between you and your competitor. That's how I look at it, and that's the biggest mistake that founders make. They think I'll show scale on meta ads, but their unit economics will be completely messed up. So these are mistakes people make. I think even when you're pitching, you need to be very concise about what you're trying to say. Your problem statement needs to be narrowed down very specifically. A lot of founders say, we're building for this thing, and in 6 months we'll do this, in 10 months we'll do this, in 12 months this will be our targets. As a 2-month-old company, there is no way possible where you're going to be in the next 12 months. So you need to narrow down your problem statement and show hyper focus on that one problem statement that you're chasing, where you have found some early signs of PMF. That's it.
Thank you so much, Jaitra. This was very insightful. A lot of learning as a future possible founder. I have learned a lot from you. Thank you for giving us your time.
Thank you so much for having me, and thank you for having this amazing setup for me today. Thank you so much.